We're going to be watching the Bank of Canada again this week because it is expected once again to raise the interest rate on Wednesday at a supersized increase again. Most analysts say, which could take the interest rate overall up to 4%. The central bank has been increasing the rate to try to cool off inflation, but more Canadians this morning say rising interest rates are a worry as well. A new poll just out from MNP says that 6 out of 10 Canadians surveyed said they're concerned about the impact of higher interest on their financial situations. And 84% say they're being more careful with how they spend their money. MNP also points out that low-income Canadians and people who rent are more vulnerable to these rising interest rates. So that's a bit of a backdrop for a conversation this morning with our senior business correspondent, Peter Armstrong. Now, Peter has a weekly online newsletter that's called Mind Your Business, and hopefully it's part of your morning routine. He's going to be part of our morning routine, too, on a weekly basis. So good morning, and welcome back.
Good morning, Heather.
So this perfect timing, because Wednesday we have, Peter, as I was mentioning, this Bank of Canada announcement, and I was, as from my reading and from your newsletter, looks like it's going to be another outsized increase. What's coming?
Yeah, look, there's quite a bit of debate as to whether the bank is going to go 50 basis points, so a half percentage point. A lot of people seem to think it's closer to 75 basis points. There's even some out there calling for a full 100 basis point interest rate hike, which would be another remarkable move. And the debate there is, does the bank want to get enough out in front of this that it can slow down and not have to do any more interest rate hikes going forward? But Heather, this is a blockbuster week. We're going to get a ton of information about the state of the economy. We're going to get a ton of new data, not just about where the economy is, but what the impact of the decisions we've been making have been. So you've got the Bank of Canada on Wednesday. We've got GDP numbers on Friday, which is going to show, has the economy begun to react to those interest rate hikes that we've seen that have come so fast and so sharp? And we also get some jobs data, right? We've lost, 95,000 jobs just since the beginning of June in the economy. Is that beginning to reflect a deeper malaise within the economy? Because, of course, the tool they're using to bring down prices is also going to slow down the economy. It's encouraging me and you to maybe delay that fancy lunch you want to go have, or the winter coat I was thinking about buying. Maybe I'll hold off on that. And if you scale those decisions out over a population, you'll slow the economy pretty quickly, pretty dramatically. And the trick there was, were they going to be able to do that without slowing us all the way into a recession? And right now the forecast is saying no, they won't. That we are headed towards a recession. Maybe the end of this year, but probably into early next year. So really crucial week of data we're going to get this week.
Hold on the recession thought for just a second, because I'd like to talk about it in a little more detail. But when you mentioned the rates going up now to maybe 4 and getting in front of it, sort of front loading this with this increase on the part of the governor, Tiff Macklem, there are a couple of graphs in your newsletter which are interesting. So even though let's bring up the first one, even though inflation, the interest rates are as high as they are, here's the inflation rate. Below it, you see the interest rate. So does that mean it's not working or not quickly enough? What does this signal, Peter?
Well, look, the rule of thumb is that it generally takes about 18 months for monetary policy, for interest rate hikes to work their way into the economy. When you see that beginning to drop off, that's really positive news, and we shouldn't lose sight of that. You go through the numbers. Inflation peaked at 8.1% back in June, and it's come down by a notch ever since. But it feels really stubbornly high, and core inflation, you and I have talked about this before, is still accelerating in some cases. So that's a problem. But you can also, we have a chart from an economist at Laval University in Quebec City named Stephen Gordon, who's been following the shorter term trends. And these I find fascinating. That sure, we saw the big spike, but if you follow those shorter term trends, these aren't the yearly numbers that we were just looking at in the broad headline chart showed earlier. These are just sort of 3-month, 6-month, 9-month trends. And look at that 3-month. It's really falling like a stone. So we are seeing progress. It's just not translating into the big headline year over year comparison yet. And so people should take some comfort in that it is working. But the Bank of Canada feels it's not working fast enough, and that's why they feel they've got to do another supersized cut.
And why people are talking about recession, and a small one. a limited one. Moderate is kind of another word or a descriptor I've been hearing of all of this, but the whole word recession is a scary one for so many people. Why do some people indicate, Peter, that this might be something that's the necessary tool right now? We need it maybe right now.
Well, the central bankers are certainly saying that. We've got economists who are saying that's not the case. You shouldn't be slowing the economy into a recession. But like the argument from the central bank's point is that a moderate and short-lived slowdown in the economy that tips slightly into a technical recession is better for the health of the economy and for its participants than longer dealing with inflation. And if you let that get out of control and it becomes de-anchored from inflation expectations, then it's going to get a lot harder, and the tricks and tools that they have to bring it down become a lot more painful. So they're saying if we can do a little bit of pain now, we can avoid a lot of pain in the future. But look, it's a gamble, and they say a short-lived, a mild recession. The problem with that, Heather, is once you start shrinking an economy, it doesn't take much to nudge that into something an awful lot deeper and an awful lot more pain.
First of hopefully many conversations to come. Thank you, Peter Armstrong, our senior business correspondent.